So here's the checklist on the fund of funds. And like I said, I've put these in sort of a question format. So I've got 6 of them, but these are kind of the questions I would go through when you're thinking about doing a fund of funds. And the first one that came up, which is fairly obvious, but I wanted to go through it anyway, because it's not obvious for everyone. And that is, what entity do you create? I think a lot of people, when they talk about funds, whether it's a regular fund or if it's a fund of funds, the structure isn't as clear as they'd want it to be. And you've just got to remember that a fund of funds or a fund is no different than any syndication, right? So the first thing you're going to do is you're going to create some kind of an entity. And that entity is generally going to be an LLC, a limited liability company, just like when we do a regular syndication. Now, if you're doing some particular asset classes like, oil and gas, or if there's a particular reason for it, you could theoretically do a limited partnership as your entity. But just like any other syndication, you want to do an LLC. And remember, the only difference at the end of the day, the only difference between a regular fund, a real estate fund, and a fund of funds is this. It's identical in 99% of the situations, except for instead of buying a piece of real estate, when you do a regular fund or a regular syndication, you are buying shares in a company, right? You're buying into somebody else's syndication, one that presumably you don't control. So you're going to be a limited partner in somebody else's syndication. So your income, your revenue actually comes from the distribution, the LP distribution that the underlying syndication is giving you. That's your revenue. So it's not going to be the revenue from, or the cash flow, or the revenue from the rents and all that stuff, which you would usually get in a regular fund or a regular syndication. It's literally going to be the LP distributions that go out to the investors. You are going to be one of those investors, and that's going to be your distribution. So that's going to be the revenue for your fund. And quite honestly, you're not going to have that many expenses. Like when you do a regular fund, or a regular syndication, you've obviously got all the expenses associated with running the syndication. Here, those expenses are going to happen at the underlying level. And so you're literally going to have, obviously you've got to file tax returns, K1s, all that stuff. And that will cost you a little bit of money. You've got your asset management fees and all that stuff. But really from a expense standpoint, it's not going to be that big of a deal. So that's really the main difference. In fact, if you look at the operating agreement, there really shouldn't be that much of a difference. It's just literally the asset class that you're purchasing is slightly different, which is, as I mentioned, is shares in somebody else's company. No different than if you were buying Apple stock or Google stock or what have you, Tesla stock. You're just happening to buy stock or really membership interest or maybe LP interest in another syndication. So that's really the first thing you want to talk about, is what entity do you want to create? The second question is, again, very similar to a regular syndication, is what exemption to registration are you going to use? When you're doing a fund of funds, you're selling securities. And so you're going to go through the same exercise as you go, which we're not going to go through right now, but it's going to be, are you doing a 506B, 506C, Reg A, same question, same analysis. Now, the only difference I would point out is that because you're doing a fund or a fund of funds, your universe kind of opens up a little bit. So there's some exemptions that you wouldn't typically do on a project specific deal, like a Reg A. A Reg A starts to make sense when you're doing a fund of funds. Regulated crowdfunding might be another thing. So there are other exemptions that you might dismiss if you're doing a regular fund, or I'm sorry, if you're doing a regular syndication. But when you're doing a fund or a fund of funds, because you don't have a deadline that you have to close within 3 months or 4 months or whatever it is when you get in a contract, there is the ability to go a little bit further out. And so a lot of people tend to do 506Cs when they do a fund, but Reg A is a real legitimate option for you if you're doing a fund or a fund of funds. So definitely consider that something that you wouldn't think about. Whoop, there goes my battery. You wouldn't think about if you were doing a regular syndication. I did get my backup notes here, so let me just make here. So that's number 2. Number three is how much assets under management do you have or will have at the end of this fund? And by assets under management, I mean, how many assets, how many LP interests, right? How many underlying syndications are you going to own in the aggregate? And the reason that's important is because once you hit a certain amount of dollar amount of assets under management, there's going to be different compliance requirements. So let me explain. If you are under $100 million in assets under management, which I'm guessing is going to be most of you, but if you're under $100 million in assets under management, you are not allowed to register with the SEC. And when I say register, I meaning the investment advisory. So maybe I should back up there because I think I skipped a step. Because you're doing a fund of funds and you're in the business of purchasing securities, right? You're buying stock in somebody's company. We mentioned before, that makes you an investment advisor, right? And so the question becomes, do you need to register as an investment advisor? And one of the questions you need to ask yourself, well, how much assets under management do I have? Because if I have less than $100 million in assets under management, I am not allowed to register as an investment advisor with the SEC. And if I have less than 100 assets under management, you're going to be required to either register or figure out the exemption in your state. So that's why it's kind of an important threshold. And sometimes it's 150. There's some other exemptions that you can fit in terms of on the federal side, but most of us don't want to be registered with the SEC. This only really applies to if you've been doing fund of funds for a while and you've done huge funds and you've done multiple funds to the point where you're reaching that $100 million mark. Most of us are going to be under that 100 million, but it is important for you to look at your aggregate assets of all of your fund of funds that you've been doing and figure out if you're above or below that $100 million mark, because that's going to trigger whether you file or whether you not file, whether you analyze the federal statutes or you analyze the state statute. So, which kind of leads me to number 4, which is, what does your state require? Because again, presumably you're not going to be at the SEC level. If you are, DM me. We can probably have a one-on-one conversation, because I can't imagine there's too many of you guys on this call or watching this that will end up having more than 100 million, although I know you're out there. But what is the state going to require? Are you going to be required to get some kind of a license, like a Series 65 or a Series 7 or what have you? Or is there an exemption to registration in your particular state? And this is the state where you are physically located. It's not the state where you set up the fund, meaning the LLC. It's not the state where your investors are. It's where are you physically sitting down? What desk are you sitting down, or what stand-up desk are you using when you are, quote unquote, advising your fund? Because I know it sounds weird, but that's the way the SEC is going to look at you. You're advising your fund, your LLC, as to the purchase of securities. And so the question is, where is that activity happening? And that's generally going to be in the state where you reside, where you live. Unless you're one of those really unique situations where your office happens to be in a different state because you live on a border state. And so, okay, maybe we can discuss that. But generally speaking, if you're sitting in California, like I am right now, then California rules are going to apply. If you're sitting in Texas, Texas rules are going to apply. If you're sitting in Florida, Florida rules will apply. So you need to understand what that is and what your particular state says. We've talked about some of the states. You're just going to have to look at the statute. I've got a cheat sheet, which I think I've shared before. It's not really my cheat sheet. I've given a shout out before to Alex Davies, but he's got a blog called strictlybusinesslawblog.com. Maybe I'll put it in the chat after a second. And he has a sort of a cheat sheet of every single state. It's a little outdated, so it's not necessarily the end all be all. It's a good first cut, but at least very quickly it will tell you whether there's an exemption, and B, what that exemption is. I can tell you that I think there's only about 3 states that don't have an exemption. And unfortunately, I was talking to somebody the other day, and they happen to live in the state of Hawaii, and I realized that Hawaii doesn't have an exemption. So if you're in the state of Hawaii, they're going to require you to become a registered investment advisor and get that licensing requirement, which, by the way, is not the end of the world, right? It's just, but you do have to study for the exam. You got to pass a Series 65 or whatever series they want you to do in that particular state. You've got to register with your state, and now you've got to do all their compliance, and it's going to be compliant. So that's just not going to be something fun. But anyway, so that's the other question we'll ask is, what does your state require, or if anything? The next question, number 5, is going to be, do you have more or do you have less than 99 investors? And the reason this 99 investor thing comes up and only applies to fund of funds, I get this question a lot about whether you're doing a regular fund or a regular syndication. Am I limited to 100 investors? No. The reason you want to be worried about 100, it's really 100 investors, but you're considered one of them. So as the GP, you're one. So you're really left with 99 investors and or co-GPs. The reason is because you are basically a passive investor in somebody else's deal, which makes you an investment company. You're sort of a passive investment company, not actively involved. You're just a passive investment company, which subjects you potentially to the Investment Companies Act of 1940. You really don't want to be categorized as an investment company, an official investment company, because now you've got to register with the Investment Companies Act, which has a ton of regulatory compliance that you really, if you can avoid it, you want no part of. And the easiest way to get around and be exempt from the registered investment advisor, the Investment Companies Act, is to be what's called the 3C1, which is just a statute, 3C1 entity, which means you have less than 100 investors. So if you have less than 100 investors, then you're a 3C1 company, which makes you exempt. under the investment companies now. Now you want to be careful once you get close to that 100 mark, because the 100 mark is easy to, it's a clean delineation. It's either over 100 or under 100, but what constitutes an investor gets a little bit tricky and complicated. So once you get up to that 60, 70, 80 number, you may want to start talking to your securities attorney to make sure you're not, you're defining all your investors properly, because there's look-through provisions, there's husband and wives, there's all kinds of things that, entities. So you want to just be sure that you are counting your investors correctly. But that's the other checklist or question you want to ask yourself is, do you have less than 99 investors? And then the last checklist you want to make sure you're checking, checklist that you're checking, is, are you adding value to your passive investors? Because if you're not, there's a chance that the regulators will see you as basically just being a broker. You're just raising money for the underlying syndication. And if that happens, you're, again, an unlicensed broker, or whatever compensation you're getting is going to be considered a disguised commission. And so you really want to be in a position where if the regulator were to question you, you're going to be able to say, yes, here are the 3, 4, 5 things I was doing to add value to my investors. And that's what I'm getting compensated for. I'm not getting compensated to raise money for Jared's deal or August's deal or Greg's deal. I'm getting compensated because I'm adding so much value to my investors. And I think I've gone through these before, but the main ones are, number one, obviously doing the due diligence on the sponsors and the investors. That takes a lot of time. Passive investors, they're busy. That's why they're giving the money to you so you can go do all this work, but you've got to do the due diligence, right? And by due diligence, I was just talking to somebody last week, and they're hopping on a plane, right? And they're flying out to meet with the sponsors. And then when there's a deal available, they're going to go check out the deal. They're going to, they're going to do their due diligence on the property and on the sponsors. They're not just going to take whatever the sponsors gives them and just look at the documents and say, yeah, I like this or I don't like it. They're going to do independent verification, which obviously adds a ton of value to your investors. The other thing you're going to do to add value is you're going to go in there and use the power of the group and negotiate better terms for your investors, or for your fund, really, and that benefits your investors, because you're coming in with a large chunk of cash, $500,000, $1 million, $2 million, $3 million. That might represent 25, 50, 80% of the funds from the underlying syndication. And that puts you in a really strong position. So you should be negotiating better terms, whether it's financial terms, whether it's discount on fees, maybe the asset management fee gets cut, or maybe the carried interest gets cut for the sponsor, which generates more revenue for you. Maybe you get a seat at the table where any major decisions get made, they're gonna at least consult you. So you're benefiting your investors and being a little bit more actively involved in the deal and have something that adds value to your investors. Those are really the 3 big ones. There's other little ones you want to do, but again, the mentality that I want you guys to have, because I come across a lot of people that they find a deal, they like the deal, they want to go raise a bunch of money and then invest in the deal. And if that's all you're doing, then you're going to be subject to the Investment Advisory Act, which means you should be registered as an advisor, right? And you should be invested as a broker. And so those are kind of really critical items to think through, is what value are you adding to your investors in this particular deal? And to me, the easiest way to do that, and it's something that we're trying to figure out a way around that, or how we can help other people too. But generally right now, what we're doing is we're limiting the fund of funds to blind funds, right? Because if you come in and you raise capital under a blind fund without specifically mentioning specific deals, then what you're really getting paid for is selection, right? You're raising a bunch of money, you have it in your fund, and now you're going to go out to the marketplace and you're going to review and underwrite a bunch of different deals. Maybe you're presented with 10 deals and you say, look, I've looked at 10 deals. I like these 2 and we're going to invest in these 2. That is obviously a huge value add to your investors. That's really what you're getting paid for. You're a capital allocator, you're a stock picker, whatever you want to call it. So anyway, that's kind of my big picture checklist. Like I mentioned, the question came up. It was Justin actually a couple of weeks ago. Justin asked the question, and it was just kind of like, is there a checklist? What should we be looking for? And I think those 6 questions, at least from the legal standpoint, will cover you at least thinking of all the legal ramifications that you got to think of. Obviously, and I'm happy to go into the details if you've got questions. Obviously, there's a lot of stuff going on in terms of the actual fund, how to structure it, and there's checklists about that. How do you address certain things, and we could talk about it if you guys are interested. But that's kind of my little short rant for today. And with that, I'd like to open it up to Q&A specific to the topic of fund of funds, if that's Hopefully that's interesting to you guys, or maybe I've been talking about it too much that you guys are done with it. But and if not, we'll go into sort of general Q&A and AMA, and I've got a couple here in front of me, and then we'll open it up to everybody else. So put a comment down there. I see Mustafa already asking here, hey Mauricio, what if you're sitting in Canada? That's a great question. So there's an exemption called I forget the exact name, but there's a sort of a foreign exemption. There's a specific name for it. It escapes me off the top of my head. But you know, if you're doing less than $100 million, right, and you're not allowed to register under the SEC, then you have to go by the states. Then there's going to be that foreign exemption because you're obviously in Canada. Now, remember, Canada has a pretty robust securities, body of law. So you definitely want to make sure that you're checking with a securities attorney in Canada. I don't know. I would say I don't know much. I don't know anything about Canadian securities laws. I do know it's somewhat similar to ours, but not exactly. So you're not going to have to worry about the states. Obviously, you're not sitting or advising your fund as to the purchase of securities in any particular state, so they're not going to have any jurisdiction over you. But you're gonna definitely want to be talking to your Canadian securities attorney for that. Greg, how you doing? Good to see you. Mayura, did I hear that the LLC should be a partnership and all the fund investors are members of the LLC? Correct. Most of the time, I want to say in our world, every single one, I think every single fund that we've done or fund of funds has been an LLC, other than the oil and gas ones, which are very specific as to why they have to be GP. But generally speaking, the LLC is the entity that we usually use. The investors are members of that LLC. The co-sponsors or the sponsors are the managers of that LLC. And because there's multiple, it does get taxed as a partnership. Remember, LLCs, one of the beauties of LLCs is they can be taxed any way you like. I did a video of that not too long ago, but LLCs can be taxed as, if it's just you, it could be taxed as a disregarded entity. They can be taxed as a partnership. It can be taxed as an S corp. It can be taxed as a C corp. But in a fund, because you're going to have multiple members, most likely it's going to be a partnership return. Although definitely check with your CPA. Greg, with regards to distributions and waterfalls, is there a current industry preference, i.e. a fixed but high pref with no promote to the LPs versus a 3 or more tier waterfall with IRR X hurdles? Let me repeat the question. I think I got it, but just so everybody. So with regards to distributions and waterfalls, is there a current industry preference, or maybe it's best practice, about how you go about doing that? If it's a fixed but high pref with no promote or multiple waterfalls? Most of the deals I've seen, I mean, this is, I don't know if you want to call this a current industry preference, but this is the one that we see the most, is you don't want to go too crazy on waterfalls, just in general, right? We've had that experience before where if you do too many waterfalls, it gets crazy. But we do see a lot of, I would call it a two-prong waterfall. And I use one of them as your preferred return. So most of these have a pref, right? So whether it's a 7%, 8%, 9%, it's usually about 8, I would say, is the industry standard. So there's an 8% pref to the investors, which again, doesn't mean it's guaranteed, right? It just means 100% of the available distributable cash is going to go to the investors until they reach that 8%. And then there's the second tranche, I guess, right? Which is anything above an 8%, but below a number. And I've seen either 15% or 17%. So 100% up until 8% goes to the investors. Then between 8% and let's say 15, it might be 80-20 in favor of the investors. And then anything above 15 or 17, whatever you picked, will be maybe 50-50. And I've seen a couple where they completely flip, where it maybe is a pref and then it's 80-20 and then it flips to 20-80. But that's kind of the general current thing that I've been seeing a lot is that third. Now, as things have gotten a little bit tighter over the years, I've more and more don't have a pref and less have that second tier. But I don't think I shouldn't say I have never seen. I rarely see anything more than that. Just some pref and then some waterfall hurdle above that, and whether that's based on IRR or based on AAR, annualized return, we can discuss. I prefer AAR because it's simpler, but that's kind of the industry standard that I'm seeing right now, just a pref. The only time I see, Gregory, I apologize. The only time I see a high fixed and no promote at all is when you have that sort of class A or class A1 class where it really acts like a mezzanine financing. So investors come in, they get paid 10%, or usually 10%, I would say the industry, but I've seen 12, but let's just say you get paid 10%, and you're ahead in the capital stack. You're just below the lender, but you're ahead of all the other investors, but you get 10% and that's it. Right. And that's usually a separate class than the, say, class B, which they'll get the, 8% pref, 80-20, whatever waterfall you're having. But I don't usually see the high pref and no LP in general for the entire syndication, but I do see it as a small tranche, which is really the equivalent of that mezzanine financing, because what they really want is another piece of debt in there, but the lender won't allow them to put the debt. And so they kind of mask it, for lack of a better word. They mask the debt piece that underneath them, the bank lending or the main lending. They mask it as equity, but it really acts like acts like debt, except for they generally should get and do get whatever depreciation happens. So it's almost like a little sweetener on there, because they are owners of the company and they put actual cash in this, so they should get depreciation in there as well. Check with your CPA. But that's the only time I've seen sort of that high pref is when it acts like a mezzanine debt piece in between the equity and the lender. So hopefully that was clear for you, Gregory. Chaff, is there a minimum of deals you would need to create a fund originally? And can you delay distributions for a few months before starting to pay out, at least in the beginning, right after the creation of the fund? I'll answer the second question first. You can do whatever you want, to be honest with you. Very few things you can't do when putting together any syndications, even a fund or a fund of funds. So as long as it's put very clear in the documents, and you want to delay distributions, or not even, I wouldn't use the word delay, but distributions won't start until a certain event happens, whether it's a timeline. Hey, no distributions until X amount of days following, the receipt of funds, or when we start operations. You can put all of that in the operating agreement and the PPM. As long as it's disclosed, you can do pretty much anything you want. What you need to be clear about when you're delaying distributions, though, is when do they get, whatever their distribution is. Does it accrue? When does the 8% pref, for example, start? Does it start when they actually write you the check, or does it start when when you actually start getting the distributions? All of this stuff is doable. You just need to be super clear with your securities attorney so that they can then put all that information in the private placement memorandum. And is there a minimum number of deals you would need to create a fund originally? Let me answer this the right way. I would think 2 would be, I mean, if you have one deal, then I don't really consider that a fund. I consider that just a regular syndication, right? You're just buying a piece of property, and so there's one property in your fund. That's just a regular syndication. So I'd say at least you need 2 to call it a fund. But you can have anywhere from 2 to infinity, to be honest with you. You don't have to have them all identified. In fact, that's kind of the point. You don't have to have all of those funds identified at the beginning. It's possible for you to start your fund and say, hey, by the way, I've already identified the first project that I want to go in, and here's the information about that first project. But after we close on that first project, number 2, 3, 4, 5, and 100 will be similar to this one, but we haven't identified it yet. Or in a blind fund in general, you haven't identified any of them anyway. The whole idea of a blind fund or a fund of funds is for you to go raise the capital first, so that you have that capital available to you, and then you can deploy it at a moment's notice, either get leverage. And when I say leverage, I mean, an advantage over other people because you've got the cash in the bank, or, once you identify a sub syndication or a deal you want to invest in, you can just pull the trigger. So there's definitely no minimums. And again, I say this all the time from stage. I mean, the beauty about syndications is you can get as creative as you want to be. I always joke, if you want to take 99% of the profits and give 1% to the investors, you can knock yourself out as long as you disclose that. Nobody's going to invest in that deal, but you can pretty much do anything you want. The only things really you can't do is the stuff we talked about being raising capital, getting paid for referral fees, all that kind of stuff. But in your documents and when you're structuring things, you can be really creative. I would just caution you. I went through this back in the day when I was general counsel for the real estate guys. We did at least one deal where the waterfall was so freaking complicated that it was really difficult to explain to investors, and a confused investor is not a good investor. So you don't want to go super crazy when you're structuring these things. But if you want it to be, you can be as creative as you want to be, as long as you disclose, which is what the private placement memorandum is for. Gregory, also, is it typical, let me do that again. Is it typical for GPs to quote unquote share their Excel models, the actual Excel file, with the LPs as part of their due diligence? No, I wouldn't say it's typical, but that's probably just because they're not asking for it. But I don't even want to see your actual Excel files. In fact, if you've worked with me before, I specifically say, sometimes they'll send me that whole, Excel spreadsheet with 100 tabs on it. I'm like, I don't want to see any of that. That'll give me a headache. I just want to see the one pager that you're going to send, the 5-year, the 7-year pro forma that the investors are going to see. So it's not typical. I'm not saying it doesn't happen. My only concern with sharing it is that especially if you have non-accredited, if you're going to share it with one investor, you probably need to share it with all of them. So if you want to share it, I think the best practice would be to reference it somewhere in your business plan with a link. So you don't want to include it all there, but it's like, hey, here's the pro forma, here's our assumptions, maybe in the financial analysis section of your business plan, your 7-year pro forma, maybe there's like a link. Hey, if you want more detail, whatever, click here, and it takes you to another link, or if you want more details, email us and we'll send you, an exhibit. So you can do it, but I wouldn't say it's the word typical, but if somebody asks for it, you just got to be prepared for it. Jared, let's see if this is your blockchain question. Do you find that investing in a fund of funds is a safer investment versus a single property syndication? Oh, great question. I don't think it's one or the other. I don't think it's the same. I mean, you could argue that it's because it's diversified, right? Because you've got multiple properties in there, and so you diversified the risk. So there's an argument maybe to be made that a fund is safer. But on the flip side, I could also argue that it's a little bit riskier for the investors because they don't actually see what investments you're going to invest in, right? So traditional syndication, you're going to show me the property. When I invest in let's say you're doing a single property, I'm going to know exactly what the property looks like, where it's located, what part of the market it is, what the trailing 12s are. I can look at all of your assumptions. I can look at the rent growth that you believe are going to happen. I can say, Jared, you're smoking weed. There's no way you're going to get 5% rent growth over the next 5 years. I think you're going to get 2% or 0 or whatever. I have that ability to to understand your assumptions, challenge your assumptions, and also look at this exact market and what side of the street that particular property is and how big it is. When you're doing a fund, you're completely relying on the sponsor. Like you're just in full faith with the sponsor. Here's a check for 100 grand. And I just have so much trust in you because of your track record, because I know you, because you've been performing over all these years. So I'm going to do that. And so I could argue there's a little bit of risk there. So I wouldn't say whether it's safe or not. I will tell you it's easier. I wouldn't say safer. I would say it's easier to invest. I'm sorry. It's easier to, well, you said invest. It's easier to put together a single property syndication because of the reason I just mentioned. It's much harder to raise money under a fund or a fund of funds. And again, a fund of funds is just a subsection of a fund. Much harder to do it. So it usually doesn't happen if you're a first timer. If you're new to syndication, it's your first rodeo, you're probably not going to do a fund. But once you get a track record, once you've done a couple and you've got, you've done 2 or 3 or 4, you've got some investors who just keep reinvesting with you, you're just doing a great job. Then at some point, hey, maybe instead of raising, the next 5 deals into 5 separate deals, maybe I'll just do a big fund and go raise 50 million or 25 million. And I've got the track record now to support it. Nick Shea, beginner question. If your fund of funds is set up as a 506C, are you able to invest in 506B? That's a good question. If your fund of funds is set up as a 506C, are you able to invest in 506Bs? Potentially. So just because you're doing a 506B, for example, most people think of 506B, they think of non-accredited investors. And the vast majority of 506Bs are accredited investors only. If you look at the statistics of the SEC through those Form Ds, I think like 92% of these deals that are 506Bs only have accredited investors. Granted, these are, the JP Morgans and all this stuff, these huge funds that people put together. So it's a little bit skewed. So it's possible that if the 506, so it says, if your fund of funds is set up as a 506, are you able to invest in 506Bs? That question is yes. Let me just backtrack. I kind of fumbled this one up. If you're doing a 506C, that means all of your investors are accredited. You can invest in either another 506C or a 506B, right? There's no restrictions for you in that case. If you flip it around, it becomes that issue. If your fund is set up as a 506B, can you invest in a 506C? And that's where, if you're doing a 506B with accrediteds only, which again, a lot of people do, then you would be able to invest in a 506C, because 506C requires that everybody be an accredited investor. And in order for you to be an accredited investor, all of your investors, all of your members have to be accredited. So I know I butchered that one completely, but if your fund is set up as a 506C, that means all of your investors are accredited. Your fund is an accredited investor. You're going to be able to invest in both 506C and 506B deals. If your fund is a 506B and all of them are accredited, then you can also invest in 506C deals, right? The only time you can't do it is if yours is a 506B and you have at least one non-accredited investor in there. That means that the entire fund is non-accredited, and so you would not be eligible for a 506C. Hopefully, I think I saved it at the end, but I kind of butchered that at the beginning, so hopefully that made sense. Mustafa, what happens when you hit 100 investors? Would you start another fund of funds, or is it aggregated across all funds you are a GP of, and starting another fund of funds wouldn't help you? Yeah, you can't just get around. First of all, there's a catch-all rule for the SEC, is that if they ever think you're trying to get around the rules, they're going to nail you for that anyway. But most likely what's going to happen there is they're going to integrate those two. They're going to integrate those two funds. So it's just the same thing as when you're doing a 506B. You can't just, run into the limit of 35 non-accredited and say, well, let me just start another syndication and do class B for the same deal. And now I get to a fresh 35 non-accredited. Those are generally going to be integrated, and same thing with this 100. You can't just circumvent the rules by creating a new entity. Now, if it's a completely different deal and they're separate, that's fine. But otherwise, they're just going to integrate them, and it's just a way for you to try and get around it. So that's not going to work. So what happens is, once you hit 100 investors, if you do hit that, then you just technically you're no longer what we call a 3C1 company, which is the exemption. So then you kind of go back to square one, which is, well, you're an investment company. You either have to register with the Investment Companies Act, or you have to find an exemption. You can't rely on the exemption of 100 investors or less because you already hit it. So is there another exemption that you are able to fit in? And there are ways to kind of draft your operating agreement and set up your fund where you have more of an active role in those deals. So you're not purely a passive investor. And if you can make the deal active enough, then you might be exempt and be outside of an investment company. There are also some other exemptions like 3C7 that you could try and fit in. So you just have to go back to the statutes, just like in the regular securities. If you blow your 506B exemption, okay, well, I'll go back to square one. I've got to register. I've got to find an exemption. Is there another exemption? Can I do 506C? Can I do 504? Can I do whatever? And let me find some other exemption. Otherwise, you're going to have to just register with the Investment Companies Act. Mayura, there are some funds where they collect the money in advance without a target investment. Is this allowed? Or does the fund need to have a target investment? So by definition, a blind fund, that's what you described there as a blind fund. So by definition, a blind fund doesn't have a target. When you say target, I presume you mean like an identified property. With a blind fund, you don't know, you haven't identified properties yet. You just basically have come up with what we call either fund criterias or parameters. So for example, your blind fund would say something to the effect of, we are raising $10 million to go buy real estate in Florida, or real estate in the United States, or multifamily units in this area, or multifamilies in the 100 to 250 unit range, or whatever or mobile home parks, or I'm going to go buy self-storage, or I'm going to buy half self-storage, whatever you're describing is what you're selling to your investors. And then you have to go find properties that fit within that fund criteria. That's what a blind fund by definition is. So that's how most funds are set up. Now, sometimes people want to put together a fund and they've already identified the first property, which I call those hybrid funds. But essentially it's a blind fund, except I'm going to go buy 7 properties. I haven't identified 6 of the 7. I've got one, here it is. Let me give you the information about this particular project, pro forma, assumptions, all the disclosures on this particular property. And then, oh, by the way, the rest of my properties I'm going to buy in the future are going to be similar to this one because it fits within my fund criteria or my parameters that I've laid out in the private placement memorandum. So it is allowed. It's what we call a blind fund. And the follow-up question says, let's say funds were collected for an investment, but they did not close. Should the funds be returned and can it be retained for the next investment? That's going to be up to you. Again, you can structure these however you want. On a regular syndication on a single property, there's language that we use which says, hey, if it's a single property, you've identified the property, so you're supposed to close within whatever 120 days, 90 or 120 days. And I have language in there that says, if for whatever reason we don't close, then you're going to get all of your money back. And by the way, you should return all of your investors 100 cents on the dollar to your investors. So if you've spent money on due diligence or on an attorney to draft something or whatever, an LOI or whatever, that's going to be out of your pocket. The investors you're going to return all that money. If it's a blind fund, that's not, it doesn't really come into effect because you're basically raising all the money. The money's going to be in your bank account for a certain amount of time. And if you try and close on one property and it fails, you're going to go find another property. Now, I have put language in the funds where we say something to the effect of, hey, if I haven't found a property after 6 months or after a year, then we'll return your money. Because that is a concern that an investor would have, which is like, well, what if I give you 100 grand and it takes you 10 years to find a property? My money's not making any money there. So that's more of a realistic scenario, but the whole idea of a blind fund is that you're raising the money first. You're not telling the investors what you're buying specifically. So if you can't close on property number 1, you're just going to go look for property number 2. Jerry, these are great questions. Thank you. Keep bringing them down. Jared, have you ever structured a fund of funds where investors can choose which funds within the fund of funds that investment is allocated towards? FYI, I'm purposefully overcomplicating this to create a smart contract solution. This actually exists already, and I'm not right now. I'm leaning towards not liking it, but there are funds out there that allow investors to come in and basically pick when an investment comes out, they've got multiple options and you can go pick investment number 1, investment number 3, investment number 5. I'm not sure what the benefit is of that, by the way. So other than cost, maybe, but even that, I don't think it's going to save you much money. But so there's a way to structure it. To answer your question, there is a way to structure it where investors can choose which funds. The way I would structure that is I would just create separate classes. And I would say class A, if you go into class A is going to get the profit and losses and all the revenues from property A. But if you want to go with property C, then you're going to be a class C member. And if you want property F, you're going to be a class F member, right? And so you only participate in the profit and losses of those particular properties. The challenge I have with the structure in general is that even though you've segregated them by class, at the end of the day, everybody's a member of the fund. And so if there's any exposure from a liability standpoint, if something happens to property F, and there's a lawsuit, maybe property F was poorly managed and all those investors lost their money in F. If the investors come after the fund, they're not just coming after the fund F members, they're coming after all of the members. So there's a lot of cross collateral risk, so to speak, if you put everybody in a fund. So I don't know what the benefit is. And of course, if you're continually adding to your fund and you're having people just invest in a particular property, then every time you have a new property, you're going to have to provide them with disclosures of that new property, right? So if I'm adding a property to the fund and I'm thinking about investing in that fund, I've got to go through the whole syndication disclosures, just like individual syndication. So somebody needs to explain to me what the benefit of doing that versus doing 5 different syndications, considering the risk involved if something were to happen to one of those properties. Hey, Chris is in the house. Hey, Chris, follow-up question on Mayura's questions about capital sitting in the fund. Yes, sometimes when I bring up the idea of a fund, some investors ask about earning interest on the capital that's sitting in there while you don't own any property in the fund, or while some of the capital is still sitting there. You don't deploy it all at once. Yes. Is it common to pay out investors on the capital while it sits there? What scenarios do you see what scenarios do you see happening in your experience? So great question, Chris. As usual. that is a concern. And so the way that most people will handle that is they will actually take a deposit. So you go through all the exercise of doing the PPM, you go through the whole exercise, subscription agreement, all the docs, you send the docs to the investor commits to $100,000. However, instead of giving you a check for 100 grand, they give you a check for 10% of it, 10 grand. Maybe I've seen some do 20, but it's just enough so that when you ask for the rest, because what you're going to do is you're going to take 10% now, but when you find the property, you're going to do a cash call and you say, hey, you've got to, within 5 days, 10 days, whatever we decide, you're going to have to give me either all of the rest of the money or part of it, depending on what I need. And if you don't, for whatever reason, you're going to forfeit that 10%. So a lot of people take soft commitments. The problem with soft commitments is people change their mind. The economy changes, banks start to fail and people start freaking out or whatever. And so you thought you had $3 million committed, but at the end of the day, you really only have $1 million. When people put 10% and the risk is you're going to lose that 10%, that's already a 10% loss. So it's much less likely that they're going to bail. And legally speaking, they've committed to the deal. The other way I've seen it done, our good friend Brandon Turner does this on his deals, his mobile home park deals, is there's no distribution for the first year, but during that holding period, we're going to pay you. Back then it was a nominal amount. I think it was like 2 or 3%. Maybe now with interest rates higher, you'd have to give them a little bit higher return, but maybe it's 5%, which is what they'll be getting in a money market account or the T-bill. So maybe it's like, hey, if we, during the time we haven't found a deal and don't deploy it, we'll pay you 4%, 5%, almost like a checking account thing. And obviously that has to get paid out of capital. So you're gonna have to overraise and capitalize that interest payment. And that's fine as long as it's disclosed. Now, some people don't like that, because you're basically paying them back with their own money. But that's the other option. And then the other option is just like, tough in a good way, meaning, you're not going to get paid for the next 6 months, but over the life of the project, 10 years or 5 years or 7 years, you're going to more than make up for that. And your total returns are going to be huge. So those are kind of the 3 ways we're seeing it. But by far the most popular is the deposit. And if they fail to do the cash call, then they forfeit the 10%. Man, good questions. Let's keep going here. Nick, if your fund of funds is utilizing an exemption from registration, an exemption from registering, are you only able to invest in unregistered private offerings? As opposed to, so the registration has to do with the purchase of securities. So you could purchase, it's not real estate at that point. You're buying shares in somebody else's company. So if you wanted to theoretically go buy, I don't know, registered, like Apple stock or some other securities, it all has to do with the same purchase of securities. So you're not just limited to doing other syndications or other PPMs. It's the rules that govern you wanting to invest in securities. You're in the business of buying securities. Now I got to figure out what are my registration requirements. And if that security happens to be buying a bunch of businesses or buying stock or buying whatever, then the same rules apply. This is not specific to private offerings or specific to real estate or anything like that. It's specific to the purchase of securities, because that's what you're advising your fund to do. If that makes sense, Nick. Mustafa, what is the cost of creating a fund of funds and the average annual maintenance cost you've seen? What does the setup process look like, and what is included at a high level? Fund of funds generally, at least in terms of attorney fees cost, will usually run the same as a regular fund. Again, from our perspective, it's not a huge difference, right? Whether you're doing a fund of funds or a regular, they're both funds. And so that's usually in that, give or take probably 20 grand, I would say, from attorney fees. That's the kind of a flat fee. Then additional fees you would see is if you had a random state that wasn't super clear on what the registration or exemption requirements are. So you would have to then hire a funded attorney, or I think now we're starting to do that in-house. So that's probably just an hourly rate that somebody's just researching and making sure that they've got the most up-to-date information on that specific state. Maybe you need to go hire a local attorney to confirm that. But from a cost perspective, I'd say you're looking at between 20, just to be safe, 20 and 25 grand from the legal perspective. From a maintenance cost, there's unless you're forced to register with the state. Obviously, if you're forced to register with the state, there's going to be a bunch of compliance costs because every state's different, but you might have to do audited financials. You're going to have to file quarterly reports. I mean, that I don't know what that's going to look like, but that's what your maintenance fees are going to look like if you have to register. If not, the only maintenance cost you're looking at is the just the LLC. You know, you've got to register or renew your LLC every year, and that's, depending on the state, might be as little as $100 and as much as, you know, $300-400, $500 if you're in Nevada. The only other cost I could see is, I don't see too many people doing this, but some people do hire a fund administrator, like somebody to administer the fund if it's a large enough fund, and they usually charge about 2% of assets under management. So if you're going to go outsource this and get somebody else to manage the fund for you, you may have that cost as well. All right, questions. Wow, I got a lot of questions here. Kenneth, if the fund is buying a portfolio of properties, can the investors pick which one they want to participate in, or do they have to be involved in all the properties? Now, assuming and I've done this before, this is not necessarily a blind fund, because now you're telling me you've identified a portfolio. So let's say, I don't know, there's 4 properties that you want to buy, and you want to give the option for the investors to pick which one they want to get into. I kind of gave the answer earlier. I would structure it so that each class of shares, each class of membership units corresponds to a particular property. And you just draft the operating agreement, and you definitely need to work with your tax professional to make sure that the tax language in there is appropriate, but making sure that, so I would just write it in so that all of the profits and loss from property number 1 get distributed to class A members, all the properties 2 to B and C, and I would just create membership classes to pull that off. So if you already have them identified, then I would just do that into one big fund and split it up by classes. Maximo, I'm assuming 10% deposit is pretty common for experienced syndicators. Probably hard to keep 10% from friends and family. Well, you can't play favorites, right? So if you're structuring together with 10%, and again, you're not keeping it, it's almost like it's a penalty. It's really the whole point of the deposit, that 10%, is to dissuade someone when it's time for them to actually do the cash call. And let's say I've given you 10 grand and now you do a cash call for 50 grand more. You just want to avoid the scenario where, like, hey, you know what? I saw another deal that I liked even better than this one, so I'd rather go put my money somewhere else. That's what you're really trying to avoid. And so if you give them a 10% penalty, then the new deal looks less and less attractive. And again, there's nothing magic about the 10. It could be 20. We have had clients do 20%. It's just enough that you feel like an investor who's committed to 100 grand, when it's time to do that cash call and they've got to give you the money in 5 days, that they're not going to give you some kind of an excuse. Because even though legally you can, the odds are you're not going to go spend attorney fees trying to go, collect on them and sue them for performance of their syndication docs, although you certainly are entitled to at that point. Paula, commenting on Kenneth, good question. I would think that if the structure is set up to have these investors as limited partners, they will not be allowed to make any business decisions. There is legal precedent for that decision, if I am recalling that correctly. I already forgot what Kenneth's question is, but I agree with you, Paula, that if they're limited partners, the whole idea of limited partners is that they don't get to make decisions, at least most decisions. Sometimes they might make decisions on, removing the manager under certain limited circumstances. But remember, your investors, this is a point I've made before, but the more involved a member or a limited partner is, the less protected they are from an asset protection standpoint. So if you ever, this is a good pro tip, if you ever get investors who are passive and they're kind of putting pressure, or they want to get more and more involved in decision making, just let them know that potentially could eliminate their limited liability. Meaning, if something then were to go wrong in the property, right now they're limited, right? They're limited to whatever money they put in. If they invested 50 grand or 100 grand, that's the most they could lose. If the deal blows up and whatever happens, that's the most they can lose is 100 grand. But if they start making decisions and getting involved, then they may lose that limited liability protection. They're going to be more like a GP that has kind of unlimited exposure, right? If there's something that went wrong with the property. So the whole point of being a limited partner is you're going to have if you look at our those of you who are clients on the call, you know that our operating agreements, even though it looks like the limited partners may have some vote of some sort, the reality is it's so you basically need a 90% vote to get, the managers removed, or you may need some almost prohibitive or unanimous vote for things to happen, which is really, really difficult. And that's the whole point. We draft it in such a way that it really gives our client all the control. We disclose it all, but at the end of the day, limited partners are supposed to be limited. Jeff, I have a 506c fund and advertise on social media. Okay. Do you recommend for accredited investors on all posts? Yes. I have a 506c fund and advertise on social media. Do you recommend, quote unquote, for accredited investors, end quotes, on all posts talking about the investment opportunity? Look, at a minimum, if you're advertising legitimately on social media, because it's a 506c, you want to put in there at a minimum for accredited investors only, because most people then understand, okay, it's a 506c. But the ones I like, I would actually put 506c offering, accredited investors only. At a minimum, I would much rather you actually put a full-blown disclosure. And I understand that people don't want to do that, but if you look at some of them, I really should have them available and pull them up. Maybe I'll drop them in. I'll make a note here. I'm going to drop some of the disclaimers in the Facebook group. If you're not part of the Facebook group, join us. I'm going to put that in here. It's mauriciorauld.com/FB group. And I put a lot of stuff in there, and I'm going to do this there. So I'm going to put this in the chat. But if you want to join us there, I'll drop some screenshots of posts. Grant Cardone is my favorite, because Grant got into a little bit of hot water a couple of years ago. And so his post now literally has like a paragraph of disclosure. I think I saw one for Ty Lopez too that was pretty solid. So more and more people are starting to, sorry, that's Facebook group, FB group. So, but anyway, to answer your question directly, at a minimum, I'd want to see 506c offering, accredited investors only. Mustafa, apologize if redundant, but can you use the fund of funds to invest in multiple asset classes, each with a different sponsor? Yeah, that's the whole, the answer is yes. You can definitely do a fund of funds to invest in multiple asset classes. Now, you want to be, so from a legal standpoint, yes. So if you want to do a fund and you want to put some money in mobile home parks, some in multifamily, some in self-storage, some in RV parks, absolutely. Then that argument there is diversification. Great. You can absolutely do that. The one thing you want to be careful about, I would just kind of caution, it's not a legal thing, but just don't mismatch the risk, right? I have had people come up to me and say, like, I want to do a fund where it's 50% real estate and 50% crypto. Okay, well, that's kind of a big difference, right? The risk profile of a crypto investor doesn't quite match the risk profile of real estate. I've seen other people do real estate and other businesses. I think one was a marijuana company. And again, you can legally do it, but number one, you just want to make the disclosures of whatever those asset classes are, because obviously disclosures for self-storage are going to be slightly different from disclosures from multifamily, blah, blah, blah. But just from again, it's not a legal thing. Basically from a marketing standpoint, it makes it hard for investors to invest if the risk profiles are really, really off. But can you do it legally? 100%. Chris dropped his info. Yeah, if you guys want to, I'm going to be done. I'm going to do one more question actually here before I go. So if you guys want to put down your info and connect with each other, please feel free. This is a question I promised Lonnie I would answer. And we addressed it a little bit a couple episodes ago, but I'll do a little bit more of a complete answer here. If you are looking to start a private lending company focused on commercial real estate, and you take money from an investor offering a preferred return, which SEC regulations do you fall under, and does it make a difference if you have numerous investors? And this question comes up quite a bit, and I want to emphasize that if you want to raise a debt fund or a lending fund or whatever you want to call it, I call them lending companies or whatever, you can absolutely do that. The way I would typically structure lending funds is I create them like anything else, an LLC. My investors will come in as members of that LLC, just like a regular syndication. But instead of buying real estate, right, instead of buying shares in a company like a fund of funds, it's just lending money, usually to you, the sponsor, or one of your affiliate companies. And all of that is just simply disclosed. The PPM will simply say, look, I'm raising $1 million, and the sole purpose of this raise is to do a promissory note to lend $1 million to XYZ company at an 8% interest rate, or whatever the interest rate is secured by this, or whatever it looks like. You describe that loan, and that's in the PPM. And in fact, in those scenarios, you would actually have the loan document drafted or the line of credit drafted. So, but it's a security. Debt is a security. So there's nothing special about a loan from that standpoint. So in terms of the SEC regs, Lonnie, 506B, 506C, Reg A, you've got to pick whatever you do. And if you want to give them a preferred return or a fixed return, that's probably the easiest. If you want to give them a fixed 10% to your investors, knock yourself out. Now, you've just got to be a little bit careful on I'll give you one little pro tip on the lending companies, is that if you're going to take fees, just don't forget your company has expenses, right? So you're going to take acquisition fees, or you've got to pay your CPA, you got legal fees. I mean, there's a little bit of compliance cost, right? So if you raise $1 million and you're promising your investors 10%, but you deduct a bunch of fees, so you end up with 950,000 and you're only investing 950 and you're getting 10% on the 950, you're going to be short. So your loan is going to have to be a higher interest rate to cover the expenses of the lending fund, so that the net results in whatever you've promised to the investors. My recommendation is to do that as a fixed return, as opposed to, you could do it as a profit split, but I would do it as a fixed. The one difference with a lending fund that comes up, and it's not really my domain, so you want to probably ask a real estate attorney here, is that some states have some restrictive lending laws. So if you raise money into your lending, like for example, California recently passed a pretty onerous, shocking, they passed a relatively onerous lending law here in California, so that it made it really unpractical for someone to raise money into an LLC, which we can do from an SEC standpoint, 506B, 506C. But then when you make that loan, it's regulated by this California lending law that came out, I think 18 or 20, I forget which year. And so you just got to check your state. If you're in the state of Michigan or Texas or Florida, you just want to make sure that you're checking with a real estate attorney. I think it's usually the attorney that knows, just to make sure that there's no some other law, lending, finance law out there in your particular state that would govern that transaction. But from a SEC standpoint, same thing, 506B, 506C. All right, guys. Hey, that was awesome, man. Great questions. Really appreciate you guys coming out. We'll see you next week for sure. And quick announcement right at the end before everybody leaves. I think next week we're going to do it on Tuesday, but I am going back to Wednesdays. If you guys remember, live started on Wednesdays, and I moved into Tuesday because I was coaching my daughter's soccer team on Wednesdays. Not doing that anymore. So probably in May, or the second week of May, I'm going to switch these back over to Wednesday, just as an FYI. I'll obviously send an email out and put stuff in the Facebook group community. I'll hang out for 2 more seconds and mute, just so if you guys want to capture people's info and connect, knock yourselves out, and we'll see you next Tuesday. Thanks, everyone.